What's going on, guys? Bexio, and we know the stock market is in a pretty difficult place with every single index in bear market, pretty much. And now we just have to see how long will this bear market last? How bad will it get? Or has it already gotten as bad as it's going to get? We can look at other previous bear markets and why right now is probably the best time to actually start investing your money. And we can do that by looking simply at this chart right here. This just shows kind of bull markets and bear market cycles and what happens between each two. So you can see coming out of this massive bull market, we get into a bear market that's minus 14%, into this bull market that's plus 60, and then so on. And you can see it's kind of just gets pretty massive at some points, like here for minus 17 to up 281 or 526. So bull markets can go crazy. Bear markets can also go crazy. Minus 43 is massive, and that's happened twice here, and a minus 51. So it can get bad on both sides. But if you look over this over a long term, the bear market is always followed by a bull market. Every time it's always followed that way, and the chart always goes up and to the right. So if you have a long enough time horizon, the stock market always goes up and to the right. So you just have to kind of know that you're looking long term and in great companies and great assets. So not if you're speculating on penny stocks and day trading, all this stuff, then you probably doesn't matter what happens with bull markets and stuff. You can still be a loser when there's 526% gains or you're day trading. But if we look first at the average bear market type stuff, we can see the average bear market lasts about 14 months, with the return being negative 22%. So with that showing 14 months negative 22%, that's the average. So right now we're actually kind of close to that, where we can see that for year to date we are down 20%, so pretty close to the 22. If we went to the bottoms here, it was minus 23 and a half. So could that be that this is the bottom here? Maybe. Depends on what else happens. But for averages, it could be pretty close that this is the bottom. But we haven't hit the earnings recession, with companies' earnings getting worse and things like Apple coming out and saying, our earnings aren't going to be as good as we thought. That's going to be a huge blow if Apple does that. But for right now, we see kind of bottomed here and just kind of trading sideways into some chop for the last couple of weeks. But again, the average would say that this could be the bottom, but we do know that obviously there have been markets that have been worse than 23% down. We have 24, we have 43, we have 50s, but for the averages, it would be maybe that's pretty close to the bottom. Or even if we look at this too, where we go for the year and we look at the kind of peak here, and we know January 3rd, so about January, the 1st of January is where this kind of started this downward turn here. And that would mean we're about 7 months into this bear market, which obviously it would be halfway through the bear market's average time period. So although the percent is around the average, we still might have 7 more months to go to be an average. But this chart doesn't include 2020 as a recession. It doesn't go that far out, but 2020 was an anomaly recession, kind of. It was super quick and then a really rapid recovery. So we can kind of leave that out as an anomaly. But 14 months, we're at 7 months right now. It could mean that maybe we have a bigger bear market where maybe the index goes down 30%. I don't see it really plummeting to like 40% down for the year or something, off of, unless just catastrophic earnings and stuff going on. But unless that happens, maybe the percentage is about right, but maybe we get stuck trading sideways. But either way, when you look at this and you can compare it to bull markets, why it's a good time to be investing during bear markets. You see negative 22% is the average. But if you look at the bear market or the bull market, you can see the average bull market returns are 125%. So the average bull market lasts 40 months and returns 125%. So if you're investing during these downward times and bear markets, and then you hold long enough and you continue dollar cost averaging into great assets over a longer period of time, even over just one cycle of a bear to bull, you can make a lot of money, over doubling your investment. and it could go on for 40 months, and that means for 40 months your portfolio goes up, so it's always a good thing. Why a massive saying that people say is millionaires are made in recessions, and recessions are where you should start investing, because you can get these massive discounts that are affected from outside things, from companies. Like, just take Apple for example. Apple, there's nothing wrong with Apple. They're not going to go bankrupt, they're not going to disappear this bear market, they're fine. And people are super scared about what's going on right now, so they are discounting Apple and they're bringing the price down. Apple hasn't fallen that much for this one, but then when the things turn good and Apple starts printing money again and everyone's buying iPhones and iPads and everything, then Apple makes a ton of money, the stock skyrockets, they do tons of buybacks, and it's just good for the market. So right now would be the time to invest, because you don't have to worry about right here where you have everything's on discount for great assets. If you're playing penny stocks, I mean, you can still get burned pretty bad. But if you're playing great assets, blue chip stocks, indexes, then you can go from investing and watching things go down and lose 22%, but then in the following 40 months, go up and return over doubling your money. We can see kind of the devastating effects of this market from Goldman Sachs, where they have lost lots and lots of money. So you can see here their asset management. All you got to do is look at their public one. I don't know, private, it seems like it's not affected really, but public for quarter 3 of 2021, they lost $820 million compared to a gain for the last quarter. And then you go on, quarter 4, they lost $500 million compared to a gain the last quarter. And then quarter 1 of this year, they lost $620 million compared to a positive gain last quarter. And then quarter 2, this previous quarter, $660 million loss Goldman Sachs took compared to a gain yet again. So Goldman Sachs has lost like $2.6 billion in assets, in investments from people, customers using their stuff. So it's not like Goldman Sachs directly, but Goldman Sachs, the platform, has lost $2.6 billion, which is crazy to think about. They've lost so much value. That's just how turmoil the market has been. But if you want to compare that, you can see bear markets, there's going to be big downward turns. We've already lost 23%, the max 20% right now, year to date. And if we continued that trend, maybe we go down to something like a 30% loss, and the losses get worse. But then when it flips, you don't want to miss out on this flip, because the bull market flips are aggressive and go up fast. You can see every single bear market, you go minus 14 to plus 60, to minus 8 to plus 40, minus 22 to plus 90. You take even bigger extreme ones, you go from negative 17 to plus 281%. And here, minus 15 to plus 526%. So you don't want to be sitting on the sideline when there's a massive bull market ahead, because it's always happened. Historically, it's always happened. A bull market has always followed a bear market, and over a long enough period of time, the chart always goes up and to the right. So you don't want to sit out and say, this bear market, I'll invest when it's safe again. And then when it becomes safe again, maybe you've already missed out on a bunch of these gains. And instead of 526%, you can get 30% or 80%, which is still could be good, but is nowhere near what you could have got if you just stay in the market, DCA during downturns into great assets. So that's why it could be a massive good time to start investing with lots of things on sale, blue chip stocks falling for no reason other than, they did really, really good in the previous quarters and the pandemic quarters, but now they're not quite as good, but they're still just massive companies. Things like Apple, they're not going bankrupt. They're not going to disappear. They're going to continue printing money. These blue chip stocks are not going to disappear from this. Smaller companies, maybe they could. If they're in trouble financially, they could disappear. But if you just stick to blue chips, ETFs, then you could ride out the down wave. And once it reverses, you're going to want to have been buying all the way down, so that when it reverses, you can enjoy the gains that come after that. But that's going to do it for this video, guys. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. And I'll see you guys in my next video.